Something truly unprecedented has just unfolded within the global capital markets, and if you weren't paying close attention, you almost certainly missed it. BlackRock, the world's largest asset manager, commanding a staggering $14 trillion under management, has just quietly, yet significantly, reallocated a colossal $2 trillion in capital exposure. That's trillion with a capital T. They executed this monumental shift without a single press release, without a flurry of headlines, and without any public fanfare whatsoever. This wasn't mere conjecture circulating amongst speculative circles on financial Twitter. This wasn't unsubstantiated rumor from some attention-seeking newsletter attempting to scare you into clicking a link. This was the movement of real capital, real positions being systematically relocated across the world's markets. And the precise direction of this move reveals everything you need to know about where the next epicenter of wealth creation is undeniably emerging. Over the next 20 minutes, I am going to meticulously reveal precisely what BlackRock is doing, where that $2 trillion is flowing, why this profound rotation is rapidly accelerating right now in early 2026, and most importantly, how you can strategically position yourself to profit immensely from this shift before it becomes glaringly obvious to the everyday retail investor. Because once this story breaks on mainstream financial news outlets like CNBC and Bloomberg, signaling breaking news, the most straightforward gains will have already been captured. The major institutions will have long since established their positions, and you'll find yourself buying at the peak. Allow me to start by providing you with essential context regarding the sheer scale we're discussing, because most people fundamentally misunderstand the true nature of BlackRock. BlackRock isn't merely a hedge fund making audacious, high-risk bets, nor is it guided by the intuitive hunch of a lone investment guru. BlackRock manages an astonishing $14 trillion in assets. $14 trillion. To put this astronomical figure into stark perspective, their managed assets surpass the entire gross domestic product, GDP, of every nation on Earth, save for the United States and China. If the global stock market were a vast chessboard, BlackRock doesn't merely command a few powerful pieces, they effectively own the entire board itself. Their influence permeates every corner of the financial world, from your personal 401k and pension funds to sovereign wealth funds and prestigious university endowments. They hold significant stakes in almost every major publicly traded company on Earth: Apple, Microsoft, Amazon, ExxonMobil, JP Morgan. BlackRock is consistently listed among the top 10 shareholders of virtually every company within the S&P 500. Thus, when BlackRock orchestrates a capital shift on this colossal scale, it's far from mere speculation or a gamble. This represents a meticulously calculated repositioning, underpinned by proprietary data and insights that remain entirely inaccessible to the vast majority of individual investors. Larry Fink, BlackRock's esteemed CEO, commands an arsenal of economic intelligence, cultivated through investments running into millions of dollars. He oversees dedicated teams of analysts who tirelessly scrutinize intricate currency flows, profound demographic shifts, subtle policy changes, and sophisticated probability models, resources that individual investors simply cannot access. But here lies the elegantly simple truth, the beautiful part, as it were: we don't necessarily need their proprietary data. We simply need to observe their actions, to watch their hands. And recently, those hands made a decisive move, reallocating a colossal $2 trillion out of U.S. market exposure and into emerging and international markets. Let me be absolutely unambiguous about the implications and non-implications of this strategic shift. This does not mean the United States is teetering on the brink of collapse tomorrow. This does not mean you should panic sell your entire portfolio and emigrate to Thailand. What it does signify is a fundamental rebalancing of the global growth paradigm. Capital, much like water, inherently seeks the path of least resistance and greatest potential return. And currently, for the first time in more than a decade, that optimal path is clearly diverging away from U.S. equities and gravitating towards international markets. This brings us to the pivotal distinction separating institutional investors from their retail counterparts: timing. Retail investors, by and large, are reactive to news. We see a headline, our emotions are stirred, and we then buy or sell based on fear or greed. We are, by nature, reactive. Institutional investors, such as BlackRock, act preemptively, positioning themselves long before the headlines are even conceived. Their strategies are predicated on sophisticated, forward-looking indicators, rather than reactive responses to historical news. And by the time a particular trend is lucidly articulated and explained to the general public by the financial media, that opportunity is typically already crowded out. The alpha, the excess return above a benchmark, has, in essence, already been harvested. The pertinent question, therefore, isn't whether the U.S. stock market is inherently bad. Rather, it is, from where will the next significant phase of global growth emanate, and how can one strategically position oneself to capitalize on it before it becomes self-evident to everyone else? Allow me to illuminate the compelling mathematical rationale underpinning this substantial capital rotation. Once these figures are presented, the underlying logic, I believe, will become irrefutable. In the preceding year, 2025, the US dollar experienced a notable depreciation against a diversified basket of global currencies. A weakening dollar, by its very nature, erodes your purchasing power. Even if your stock portfolio remained flat in nominal terms, you effectively lost real wealth because those dollars could purchase less. Now, let's examine how global equity markets performed in 2025. Germany's DAX index yielded an approximate return of 22%. Japan's Nikkei index saw returns of around 26%. The MSCI Emerging Markets Index soared, delivering nearly 30%. In contrast, the S&P 500 managed approximately 16%. While 16% is certainly a respectable positive return, indeed, few would complain, the stark contrast with the nearly 30% achievable in emerging markets reveals a substantial opportunity cost, a remarkable 14 percentage points of potential return left unrealized. This is the often overlooked cost of home country bias. And here's where the advantage becomes even more potent. A weakening US dollar provides a significant currency tailwind for foreign investments. You effectively generate returns in two distinct ways. First, from the appreciation of the underlying asset itself, and second, from the foreign currency strengthening against the dollar. It's a powerful double return. Let me provide a concrete example. Imagine you invest $10,000 in a Japanese stock. The stock itself appreciates by 10% in yen terms. Normally, you'd expect to make $1,000, correct? However, if the Japanese yen also strengthens by 8% against the US dollar during that very same period, your total return isn't merely 10%, it's approximately 18%, the stock's appreciation combined with the currency gain. This dynamic vividly illustrates why periods of a weakening dollar often unlock immense opportunities within international equities. You are, in essence, not merely investing in companies, but strategically aligning with strengthening currencies. And right now, both these tailwinds are perfectly aligned. Now, I need to address the proverbial elephant in the room, because I anticipate what many of you are thinking. Aren't international markets inherently riskier? Aren't emerging markets notoriously unstable? And the nuanced answer is, it depends entirely on your investment time horizon. Over short periods, yes, emerging markets can indeed exhibit greater volatility. But over extended periods, spanning 10, 20, even 30 years, the empirical data is unequivocal. Emerging markets have consistently outperformed their developed counterparts. The reason is simple. They possess the one crucial ingredient that many developed markets lack: growth. Nations like the United States, Europe, and Japan grapple with aging demographics, birth rates falling below replacement levels, and consequently, shrinking workforces. Emerging markets, conversely, such as India, Brazil, Indonesia, and Vietnam, boast young, rapidly growing populations. Young people work, they spend, they consume, and they build. That's the engine of economic growth, and capital, driven by its fundamental nature, invariably flows towards growth. However, here lies the common predicament most individual investors face: the challenge of identifying precisely which individual emerging country to back. Do you place your bets on India, China, Brazil, or Taiwan? Picking incorrectly could lead to substantial losses. That's where the basket approach becomes invaluable. Instead of attempting to pinpoint the singular winning country, you invest in a diversified fund that holds a broad spectrum of them. And that brings me to the 3 specific exchange-traded funds, ETFs, that are currently capturing the brunt of this significant capital rotation. ETF number 1, VW, the Vanguard Emerging Markets ETF. VW provides you with broad exposure to some of the fastest-growing economies on Earth, including China, India, Taiwan, Brazil, South Korea, and many others. Why does this matter so profoundly right now? Demographics. These nations possess young, expanding workforces. The average age in India, for example, is 28. In China, it's 38. In stark contrast, the average age in the United States is 48. Young, dynamic populations are the ultimate fuel for economic growth. Last year, VW delivered an approximate return of 25%. This year, its price action has been somewhat choppy, exhibiting a period of consolidation. But for astute investors, consolidation, far from being a flaw, is a strategic feature. Institutions do not chase assets when they are rocketing higher. They meticulously accumulate during quieter periods, precisely when retail investors are bored and directing their attention elsewhere. Acquiring VW today is akin to buying the S&P 500 in 2003. It's not designed for a quick flip. It represents long-term, strategic exposure to the next generation of global economic superpowers. ETF number 2, EWJ, the iShares MSCI Japan ETF. This particular recommendation often surprises people. Japan? Isn't Japan's economy stagnant? Isn't it the land of the lost decades? If you still hold that perception, you are looking at outdated data. The new Japan is fundamentally different. Japan has recently undergone a massive corporate governance reform, compelling companies to prioritize shareholder returns, buy back stock, increase dividends, and significantly improve efficiency. Furthermore, the yen has experienced weakness, which makes Japanese exports more affordable and globally competitive. Corporations like Toyota, Sony, and Mitsubishi are, in essence, printing money. Last year, EWJ returned approximately 24%. At one point this year, it was up over 70% year-to-date before experiencing a pullback. Is the remarkable run over? Perhaps. Or perhaps this is merely a pause before the next significant upward leg. Here's what I know. Institutions are incredibly bullish on Japan right now. It offers a stable government, world-class companies, a currency tailwind, and a market that is finally, definitively focused on profits. ETF number 3, EM, the iShares MSCI Emerging Markets ETF. This is the broadest and most diversified emerging markets fund available. It returned an astonishing 34% last year. Let me reiterate that, 34%, while the S&P 500 managed 16%. This is the primary tool institutional investors utilize when they wish to make a macro-level bet on global growth accelerating at a faster pace than U.S. growth. They're not just betting on India or just on Brazil. They're wagering that the entire developing world is poised to outpace the United States. And right now, that is a profoundly intelligent bet. If you firmly believe the next decade belongs to the burgeoning emerging economies, you acquire EM and allow it to compound your wealth over time. Now, I need to address the psychology of this precise moment, because understanding investor psychology is, in many ways, even more crucial than grasping the underlying fundamentals. When you encounter headlines about market sell-offs, when you see Trump tweeting about Greenland or tariffs, when you observe the drama unfolding at Davos, your immediate, visceral instinct is often to panic. Your instinct is to sell, to preserve capital, and to wait for greater clarity. That very instinct, I assure you, will keep you poor. Here's what you absolutely must understand. People panic, institutions reposition. Money doesn't simply vanish from the market during sell-offs, it merely changes hands. It moves from weak hands to strong hands. Market pullbacks are simply the big players strategically moving their chips from one table to another. And here is the cardinal rule you need to internalize. Every major capital rotation feels intensely uncomfortable before it feels obvious. Read that again. It feels scary and uncertain right before it becomes self-evident to everyone. In 2009, buying U.S. stocks felt utterly terrifying. The global financial system had just seemingly collapsed. Banks were failing across the board. Unemployment was spiking dramatically. It genuinely felt as though the world was ending. But institutions were buying aggressively. And if you bought in 2009, you reaped returns of over 400% in the subsequent decade. In 2020, buying during the initial COVID crash felt insane. The global economy was abruptly shut down. Nobody had any clear idea of what was happening next. But institutions bought. And if you bought in March 2020, you doubled your money in just 18 months. The pattern is always the same. Maximum fear creates maximum opportunity. But this only holds true if you are strategically positioned before the fear subsides. Now, let me reveal the colossal mistake that 90% of investors make during capital rotations like this. They wait for certainty. They wait for the news reports to confidently declare, everything is okay now. It's safe to invest. But certainty, my friends, is the most expensive commodity in the world. Certainty only manifests after the most significant returns have already been captured. BlackRock isn't waiting for certainty. Larry Fink doesn't possess a crystal ball. He operates with probabilities, robust data, and the unwavering conviction to act when those probabilities favor a specific outcome. If you wait for the all-clear signal from CNBC, you are, by definition, buying at the top. By the time the water looks perfectly clear, the big fish will have already swum away. Now, does this mean you should impulsively dump all your US stocks and go 100% international? Absolutely not. I would never advise you to act out of fear or to make extreme, binary decisions. This is about balance. This is about recognizing that leadership in global markets is fundamentally rotating. You don't abandon the US market entirely, you simply allocate appropriately. I've previously discussed specific US sectors that remain robust: defense stocks, rare earth minerals, industrials. These represent safe harbors within the US market. However, ignoring a global capital rotation of this magnitude, especially when the largest asset manager on Earth is moving $2 trillion, that, truly, is the real risk. You don't need to predict the future. You simply need to follow the footprints. Position yourself early, remain patient, and allow the power of compounding to do its work. But there's another significant shift occurring that ties directly into this capital rotation, and it involves gold and silver. This isn't merely about prices appreciating. This represents a fundamental transformation in how the global financial system values these precious assets. Recently, under the new Basel III banking regulations, gold has been reclassified as a Tier 1 liquid asset. For decades, banks largely treated gold like a decorative pet rock. It was pleasant to possess, perhaps, and aesthetically pleasing, but it couldn't be actively used operationally. It simply sat in vaults, largely inert. But now, under these new stringent rules, gold is treated as entirely equivalent to cash. Major banks like JP Morgan, Goldman Sachs, and HSBC can now count their physical gold holdings as 100% liquid capital. They can use it as collateral. They can leverage against it. They can utilize it to meet crucial capital reserve requirements. Suddenly, gold is no longer just a safe haven. It is a vital financial tool. And when the biggest banks in the world realize they can deploy gold to expand their balance sheets and generate greater lending capacity, what do they logically do? They buy more gold. That's precisely why we're witnessing gold hit unprecedented all-time highs, surpassing $5,000 per ounce in early 2026. It's not simply fear driving the price, it's a profound shift in utility. Gold is now an integral part of the core global financial infrastructure. And here's what this means for you directly. BlackRock, the very institution managing your 401k, is actively positioning itself for this shift. Whether you personally own physical gold bars or not, this pivotal regulatory change inevitably impacts the underlying value of your retirement accounts because the institutions overseeing your money are reallocating based on these new foundational rules. Now, allow me to reveal the panic playbook, because comprehending this will safeguard you from making emotional, wealth-destroying mistakes. We have observed this pattern repeatedly before, particularly prominent during Trump's first term. Notice how adverse news consistently tends to drop on weekends. Why? Because markets are closed. They want you sitting at home on Saturday and Sunday, stewing in fear, poring over alarming headlines, and imagining the worst-case scenarios. By Monday morning, you are terrified. You sell. The market dips. Institutions then acquire your panic-sold shares at a substantial discount. Then Tuesday arrives. The EU threatens retaliation. Trump doubles down. It feels as if World War III is on the horizon. But quietly, by Wednesday or Thursday, you begin to hear whispers. Negotiations are ongoing. Talks are proving productive. Progress is being made. And what invariably happens? The market rallies. The perceived crisis mysteriously evaporates. And the very institutions that bought your panic-sold shares on Monday are then selling them back to you on Friday at a tidy profit. This is a meticulously orchestrated game played entirely on your emotions. And if you understand the playbook, you absolutely do not have to be the victim. Notice that we are now 3 cycles deep into this tariff drama, and we still haven't received specific legal details regarding their actual implementation. That is not an accident. They're intentionally keeping the situation vague to perpetuate uncertainty. Uncertainty, you see, creates volatility. And volatility, for those who remain calm and disciplined, creates immense opportunity. Here's what you need to do. Close the app. Seriously, stop incessantly checking your portfolio 47 times a day. The constant stimulation, the red flashing numbers, the incessant breaking news alerts, it's all meticulously designed to emotionally hijack you. The system wants you panicked, so you make irrational decisions. Wealth is systematically transferred from emotional investors to disciplined investors. That is precisely how the game works. You need to resist the urge to react, settle down, diligently do your research, formulate a robust plan, execute that plan, and then, crucially, walk away. But simply knowing not to panic is only half of the equation. You also need to know precisely what to acquire when everyone else is paralyzed by fear. The 3 ETFs I just presented to you, VW, EWJ, and EM, represent the core plays for navigating this pivotal global rotation. However, there is one specific sector that historically thrives during periods of geopolitical chaos. It's not technology. It's not property. This sector consistently outperforms the S&P 500 by double-digit percentages whenever global tensions escalate, and institutions are currently pouring billions into it as we speak. I meticulously broke down the top 3 stocks within that sector in another video, complete with specific ticker symbols and optimal entry points. The setup is absolutely perfect, and the window of opportunity is closing rapidly. You need to see it before this opportunity becomes crowded out. If this analysis has illuminated a capital rotation you weren't even aware was happening, then subscribe immediately and activate notifications. BlackRock just moved $2 trillion. The critical question is whether you will move with them or remain stuck clinging to yesterday's fading winners. The choice, as ever, is entirely yours. The Rothschilds created the central banking model, the sovereign debt system, the war finance mechanism, and the strategies for multi-generational wealth preservation through trusts and intermarriage. That system is modern finance, and you are living within it every single day. The Rothschilds created the central banking model, the sovereign debt system, the war finance mechanism,